Given the recent rise in U.S. interest rates, many financial advisors and their clients are concerned about the evolution of the rate environment and how they should consider positioning their portfolios given these recent trends. At PIMCO, we share these concerns. We currently are positioned fairly defensively regarding interest rate exposure across portfolios. Nearly all the portfolios that we're operating are currently underweight duration relative to their benchmark or in more absolute return-oriented strategies on the defensive side of overall interest rate exposure relative to their history. Although there will be a time to add back duration or interest rate exposure, we simply think the next few months are going to be prone to considerable uncertainty on the inflation front, the potential elevated risks of inflation surprising to the high side, and given current interest rate levels, we don't think you get paid quite enough to be operating from a neutral or certainly an overweight position. We'll be monitoring the data very, very closely to the extent that our forecasts suggest a more accelerated downward trend in some of these pressures. And ideally, if the interest rate sell-off continues and we end up with better valuations, we'll certainly adjust our position accordingly. But the bottom line, at the moment at least, we think it makes sense to be defensive, makes sense to reserve more flexibility for better entry points or better opportunities in the weeks and months to come.